Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Opendoor.
If you find our talks useful, please consider subscribing, liking, and commenting underneath. Usually when we talk about selling a house, there is this universal shared trauma we all intimately understand.
Oh, absolutely. The anxiety is just built right into the process.
Right. You're frantically painting over hallway scuff marks. You're like hiding the cat litter box in the trunk of your car because a total stranger is coming to look at your primary bathroom.
Yeah, and for 30 to 45 days, you're just praying the buyer's financing doesn't mysteriously fall through at the 11th hour.
Exactly. It's a slow, highly emotional, painfully human process.
It really is an analog transaction that's just totally stuck in a digital world. I mean, the traditional real estate market is notoriously inefficient. It's completely opaque to the average person.
Yeah, and heavily reliant on this massive web of middlemen who all take a cut, right?
Right. But then you step into the world of algorithmic real estate, and suddenly that whole open house circus just disappears.
It's wild. You're looking at a landscape where the goal isn't to charm a prospective buyer with, freshly baked cookies. It's to mathematically process residential properties. Like they're just volatile numbers on a trading screen.
That is the exact shift we're tracking. Our mission today is unpacking the rapid, wild, and honestly highly debated turnaround of Opendoor.
Because they're trying to fundamentally change how you and I buy and sell homes.
Yeah.
Right? They're attempting this massive pivot from being a simple home flipper to an AI-driven digital market maker.
And it is a transition that is aggressively shaking up the traditional markets right now.
Okay, let's unpack this, because real estate is an asset class absolutely everyone cares about. You either own a home, you want to own a home, or you're paying rent to someone who does.
Yeah, you can't really escape it.
Exactly. But the mechanics happening behind the scenes of this specific stock right now are just staggering. So here's the core tension we're looking at today. This company had $925 million worth of physical homes sitting on its balance sheet at the end of 2025.
Which is a massive, massive physical footprint.
And they are currently operating with a negative 10.1% pre-tax profit margin. Yet, the stock is experiencing what analysts are calling a retail frenzy.
It's totally counterintuitive.
Right. Why is the market throwing money at this setup when they're carrying nearly $1 billion in unsold inventory and operating at a loss? That's the mystery we have to solve today.
Well, to understand the market hype, we first have to look at the hard financial reality and the incredibly aggressive new strategy being implemented by CEO Kaz Najatian.
Yeah, they're calling this era their refounding, aren't they?
Exactly. They're essentially stripping the legacy business model down to its studs. They're rebuilding it from the ground up as a software and AI-first platform.
I want to look closely at those Q4 2025 numbers, though. Because when you use the word aggressive, the data really backs that up.
It absolutely does. The top-line revenue came in at $736 million.
Which beat consensus market estimates by 24%, right?
Yes. But the underlying operational metrics are what really reveal the mechanics of this refounding. They saw a 46% quarter-over-quarter increase in the number of physical homes purchased.
And there is one operational metric that completely stopped me in my tracks.
The acquisition velocity.
Yes, they reported a 300% surge in home acquisition velocity under this new leadership. 300%.
It's a massive acceleration.
But I have to push back here, because this is where the math starts making my head spin. I'm looking at that negative 10.1% pre-tax margin.
Right.
If you are operating a system that loses money, and suddenly you increase the speed of your acquisitions by 300%, aren't you just accelerating your own bankruptcy?
It definitely looks that way on the surface.
How is buying up everything in sight a viable survival strategy, especially if they want to hit their stated target of breaking adjusted net income by 2026?
What's fascinating here is the critical difference between raw profit and operational leverage. Let's break down the math of operational leverage because it's the entire heartbeat of their strategy.
Okay, lay it out for us.
So a company has variable costs and fixed costs. Variable costs are tied directly to the product. So in this case, the purchase price of the home, the minor repairs, the closing costs.
The stuff that changes with every house.
Exactly. And their gross margin, which only accounts for those variable costs, is actually positive. It sits at 8%.
Oh, wow. So they actually make money on the physical flipping of the house itself.
They do. The problem is their fixed costs. The massive salaries for their AI engineers, the corporate real estate, the marketing budget, the software infrastructure.
Oh, I see.
Those fixed costs are currently dragging their overall pre-tax margin down to a negative 10.1%.
So the core unit economics of buying and selling a single house are technically profitable.
Yeah.
It's the business of running the massive corporate machine overhead that's bleeding cash.
Precisely. So how do you fix that? You don't necessarily need to make more money per house. You just need to push a vastly larger volume of houses through the system.
Just sheer volume.
Right. If your fixed costs are $100 million a year and you only flip 1,000 houses, those houses have to carry a massive burden of that corporate overhead.
But if you flip 10,000 houses,
Or 50,000 houses using the exact same software and the exact same corporate team, that fixed cost is diluted across a much larger pool of revenue.
so management believes if they scale up fast enough, hence that 300% surge in velocity, the fixed costs become a microscopic piece of the pie.
Exactly. And that's what drives them to that 2026 break-even point.
Okay, that makes the strategy much clearer. But even if the math works in theory, they need cash to survive while they scale.
That's the tricky part.
Right. But looking at the balance sheet, despite that heavy $925 million inventory load, they boast a current ratio of 7.
Which is exceptionally strong.
Yeah, for anyone listening who doesn't read balance sheets for fun, a current ratio of 7 means they have 7 times the amount of liquid short-term assets needed to cover their immediate short-term liabilities.
So they aren't in distress right now?
No, they have a massive cash runway. They have incredible short-term solvency to execute this refounding.
But having a long runway doesn't automatically mean the plane is going to take off.
Which perfectly brings us to the friction point. A massive cash cushion is great for survival, but it doesn't fundamentally change the profitability of the housing transaction itself.
Right. To actually widen that 8% gross margin and hit their targets, they have to completely change the unit economics of a house flip.
And that is where the technological moat they're building comes in.
Yes. They are moving away from traditional iBuying, which historically has just been, algorithmic house flipping, and trying to become a vertically integrated technology platform.
They want to own the entire life cycle of the home transition. Let's look at the mechanisms of how they are trying to achieve that.
Okay, so first, they've introduced AI-powered scoping for home inspections.
This part is wild to me.
It really is. Traditionally, a human inspector goes out, spends 5 hours crawling through a damp basement and climbing a roof, and writes up a highly subjective report.
Yeah, one inspector might think a foundation crack is minor, and another might think it's catastrophic.
Exactly. Opendoor is deploying proprietary computer vision models where a seller simply takes smartphone videos of their home.
Just with their phone.
Just their phone.
Right.
The AI instantly analyzes the structural integrity, standardizes the wear and tear data across thousands of comparable homes, and spits out a hyper-accurate cost-to-repair estimate.
That is a brilliant way to cut costs on the acquisition side. You're completely removing subjective human pricing errors and reducing inspection overhead.
Right. But they aren't stopping at the inspection. They've also rolled out a beta program offering a 4.99% fixed-rate mortgage.
So they don't just want to sell you the physical house. They are actively moving to control the financing you use to buy it.
Exactly. And on top of that, they are laying the groundwork for real-world asset tokenization, which is...
Okay, like digitizing real estate transactions on the blockchain.
Yes, integrating stablecoin payments. It's arguably the most disruptive piece of their roadmap.
How does that actually work in practice? Because real estate is historically the most illiquid asset class in the world.
Well, think about how a traditional closing works. You have the buyer's bank wiring funds to an escrow company, the title company physically verifying the deed with the county clerk.
And the seller's bank waiting days to clear the payoff. It takes weeks.
Weeks. And everyone extracts a fee. With tokenization, you place the legal deed of the physical property into a standalone legal entity like an LLC. You then digitize the ownership of that LLC into a cryptographic token on a blockchain.
So instead of transferring the deed through the county, you are just transferring the digital token that represents the LLC that owns the deed.
Precisely. When a buyer wants to purchase the home, they send stablecoins, which are cryptocurrencies pegged one-to-one with the US dollar, to an automated smart contract.
And it just executes automatically.
Instantly. The contract verifies the funds, transfers the stablecoins to the seller, and transfers the ownership token to the buyer. The transaction settles in 3 seconds instead of 30 days.
3 seconds. That's incredible.
The friction and all the associated fees are just virtually eliminated.
Here's where it gets really interesting for me. I want to use a metaphor here. It feels like they are building Apple's walled garden approach, but for housing.
That's a great way to put it.
Right. Because Apple doesn't just want to sell you the iPhone. They want you using Apple Pay, subscribing to Apple Music, and buying Apple Care.
Yeah.
Opendoor is doing the same thing.
Capturing every piece of the transaction.
Yeah. They use AI for the inspection, they process the instant stablecoin payment, and they lock the next buyer into their own 4.999% mortgage. They capture the margin at every single friction point.
That's the vision.
But I have a major point of skepticism here. Zillow tried to digitize real estate. Zillow tried iBuying on a massive scale, and it was a spectacular, highly publicized failure.
It really was.
So why should we believe Opendoor's algorithm won't just walk them off the exact same cliff?
That is the critical question. And the fundamental difference lies in their corporate DNA. Zillow, historically, was built as an advertising and media platform.
Right. Their core business model was aggregating consumer attention and selling those leads to traditional human real estate agents.
Exactly. So when Zillow tried iBuying, they kept hitting a wall because they were treating capital-intensive home flipping as a side hustle to their high-margin media business.
Oh, I see. They didn't really integrate the transaction.
No, they just bought houses using flawed algorithms. Opendoor, conversely, is built entirely around transactional integration. They aren't trying to sell leads to agents.
Right. By controlling the financing, the inspection, and the closing, they turned what was a capital-intensive flipping business into a high-margin, closed-loop ecosystem. That makes sense. They aren't just a player at the real estate table. They're trying to own the entire casino.
But this grand technological vision doesn't exist in a vacuum. It is currently colliding head-on with the brutal analog realities of today's macroeconomic climate.
Let's look at the actual market action on that. The stock has been experiencing a serious technical breakout recently.
It has. It rallied 6.11%, pushing toward the $5.50 mark. On March 23rd alone, it was up 5.9%.
And zooming out, it's up a massive 29% over the past month.
And technically speaking, the critical psychological resistance level the market is watching is $6.
$6 is the magic number.
Yeah. Reclaiming that $6 level is absolutely necessary to confirm a broader, sustained uptrend. Breaking that barrier signals a real shift from bearish capitulation to active institutional accumulation.
But the public sentiment driving this action is totally fractured right now. We have a massive macro tug-of-war happening between competing forces.
The bulls and the bears are really going at it.
Let's start with the bear case. You have Dave Ramsey out there recently sounding the alarm that high debt burdens are absolutely crushing young home buyers.
That's definitely a factor.
But the more pressing, immediate issue for Opendoor is what happened on March 20th. Mortgage rates hit a 3-month high.
Yes.
And there's a direct line from geopolitical tensions to this rate spike. We're talking about the ongoing conflict involving Iran and the resulting surge in global oil prices.
It all connects.
I want to trace the causality here so everyone understands the mechanics. Conflict pushes crude oil prices up. Higher energy costs feed directly into inflation data because it costs more to transport goods.
Right.
When the Federal Reserve sees sticky inflation, they refuse to lower interest rates. And when the Fed holds steady, mortgage rates spike. This is a direct existential threat to Opendoor, isn't it?
It absolutely is, because it raises an important question about their balance sheet. High borrowing costs act as a double-edged sword against their business model. Well, first, it suppresses end buyer demand because regular families simply cannot afford the monthly payments at 7 or 8% interest.
Yeah, people are just priced out.
Second, and more dangerously, it physically drains cash from Opendoor. They are carrying $925 million in physical inventory.
That is a lot of houses just sitting there.
Every single day, a house sits unsold. They are bleeding money through property taxes, insurance, maintenance, and the cost of the debt they used to buy the house. High rates act as gravity against their gross margins.
That is a terrifying headwind. But then you look at the bull case, which is entirely catalyst-driven right now.
Very catalyst-heavy, yes.
On March 17th, we saw a White House executive order targeting mortgage deregulation. Now, keeping strict political neutrality here and looking at this purely through an impartial market lens, any policy that potentially lowers borrowing costs or reduces friction in federal lending acts as a massive tailwind for a company that just launched a new mortgage product.
Exactly. The market looks at deregulation as a mechanism to artificially lower the barrier to entry for buyers.
which could counteract those high interest rates driven by inflation.
Right. And it's not just policy catalysts fueling the bulls. You have analyst Eric Jackson publishing an extreme bullish target of $82 a share.
$82, that implies a 1,540% upside.
It does, and it's based entirely on his algorithmic view that the company is fundamentally undervalued given their massive surge in acquisition growth.
So what does this all mean for you, the listener? We have an irresistible force AI integration, potential deregulation, and a retail frenzy slamming directly into an immovable object geopolitical conflict, sticky inflation, and spiking mortgage rates.
It's a classic standoff.
Who is actually winning this tug of war right now?
Well, right now, the market is voting with its wallet, and it is prioritizing the deregulation catalyst and that massive Q4 revenue beat over the macro fear.
We're seeing volume surges in the technical charts to back that up, right?
We are. It confirms both institutional and retail accumulation. The market is looking at that 300% acquisition surge and determining that management wouldn't be deploying capital that aggressively if their internal AI wasn't confirming that the margins would hold up.
Which brings us to the ticking clock. Because the macro environment is so incredibly volatile, with international conflicts driving oil prices and inflation data jumping around month to month, the timeline for this investment thesis is highly compressed.
Highly compared.
This isn't a buy the stock and forget about it for 10 years situation.
Not at all. The analyst notes define the investment horizon here strictly as swing to intermediate term, which translates to a 3 to 6 month window.
So it's a tight window.
Yes. If you are watching this company, you have to monitor the catalyst calendar very closely.
Number one on that calendar, the implementation details the White House deregulation order. If that executive order actually translates into real, tangible reductions in borrowing costs for the consumer, it's a direct injection of adrenaline for Opendoor's business model.
Absolutely. And number two is the success and expansion of their 4.99% fixed rate mortgage program. Can they actually convince buyers to use their financing instead of a traditional bank?
Right. And number three, which is the absolute crucible, the Q1 2026 earnings report, expected in about 2 months.
That single report is going to be everything.
It's going to prove whether that massive 300% surge in buying homes actually translated into sustained revenue growth.
Or if they just bought a bunch of expensive inventory at the top of the market that they now cannot sell.
Which leads to the ultimate risk, what the analysts call the rolling correction risk. I look at this timeline, and it feels like they are racing against an economic clock.
They absolutely are.
Let's say we hit a recessionary speed bump before their AI and mortgage ecosystem is fully operational. If rates stay at these 3-month highs through the summer, doesn't that whole $925 million physical inventory turn into a massive anchor?
It becomes a huge liability.
They could be forced to liquidate those homes at a loss just to generate cash, which would completely derail the 2026 profitability target.
If we connect this to the bigger picture, that execution risk is exactly why the aggregate bullish score is a 7 out of 10 and not a 9 or a 10.
Yeah, that makes sense.
They carry a moderate to high risk profile precisely because they're trying to bridge two completely different worlds. They are holding almost $1 billion of highly illiquid, physical, real-world real estate while trying to build a frictionless, digital, futuristic software platform.
The analog world is still acting as a massive drag on their digital ambitions.
Exactly. Those Q1 earnings in 2 months will be the ultimate proof of concept. If they show tangible mathematical progress toward break even despite the high macro interest rates, the thesis is validated.
And if they don't?
If they show expanding losses, that $6 resistance level is going to feel very, very far away.
It is a phenomenal high-wire act to watch. So to briefly recap the journey we've just taken today, we are watching a company fundamentally trying to rewrite its own corporate DNA.
Yeah, a complete pivot.
They are executing a staggering 300% acquisition surge, integrating computer vision AI to eliminate inspection costs, and launching their own enclosed mortgage products.
All while desperately racing against geopolitical rate spikes and managing a balance sheet weighed down by physical homes.
Right. And all eyes are on that crucial $6 technical resistance level to see if the institutions really believe the narrative.
It really is a masterclass in market dynamics and the friction of technological disruption.
It absolutely is. And whether you are actively investing in the market, whether you are just saving up to buy your first house, or whether you're purely fascinated by how technology attempts to disrupt legacy industries, this is a narrative you should care about.
It's relevant to everyone.
It is an incredibly bold attempt to digitize the oldest, clunkiest, most paper-heavy asset class in the history of the world.
And it leaves us with one final, very provocative thread to pull based on everything we've discussed regarding tokenization.
Oh, I'm ready. What is it?
If real estate truly becomes as liquid and instantly tradable as a share of tech stock, what happens to the concept of the American neighborhood?
Oh, wow.
Think about it. If an algorithm can seamlessly buy and sell the house next door to you 4 times in a single week based on microfluctuations in interest rates, residential real estate essentially becomes a high-frequency day trading asset.
That's intense.
Right. Do we lose the fundamental stability of a physical community when homes are reduced to volatile, tokenized tickers on a screen?
Wow. That is a deeply unsettling thought to leave on. The idea that in a few years your neighborhood could be subject to algorithmic day trading,
Just clicking a button on your phone.
right, rather than frantically hiding the cat litter box before a stranger walks through your front door. It is a brave new world.
It certainly is.
Thank you for joining us on this talk. Keep asking the hard questions, keep challenging the market consensus, and we will catch you on the next one.